All right, let's take the discussion forward with Vinod. Vinod, afternoon. Vinod, you're making a case in your latest note that PAT to GDP ratio in India has scope to further expand from here on. Talk to us about your hypothesis.
Yeah, hi. Thanks for having me on the show. So, if you observe the profit to GDP trajectory, we hit almost a two-decade low around FY20 when we slipped below 2%. And currently, what we are observing is on a trailing 12-month basis, we have reached 4.5%. Now, one has to see this through the cycle. The peak profit to GDP that we made around 2007-8 was around close to 7% of GDP. And this was possible because at that point in time, what you call as the leverage effects were at the maximum. So you had the credit cycle at the top, and the investment cycle at the top, and the whole demand and operating leverage. So companies were functioning at full operating leverage, and the credit cycle was very strong. So what we call as the leverage effects, really pulled profits up during that time. Now, if you see current context, I mean, this from the below 2% to 4.5% that we have reached is largely because there was a large amount of lost pools and depressed profits over the last several years in a lot of these banks and industries and all, which is mean reverting to normal profitability. So if you look at the Nifty 50, we have reached around 15% ROE, basically. But our peak potential ROE has been around 25-30% during that time, which all is possible, obviously, when we have the leverage effects kicking in. So currently, we haven't seen any leverage effects, but the traction is showing up. So if you look at the indicators which can talk about leverage effects, one is the capacity utilization. It's rising, but still suboptimal at around 69% on a trailing 12-month basis. While the financial leverage, the industry credit is still low and just rising. So both are low but rising. So this gives us a confidence that the way demand is holding on and the input costs are reducing as per the latest indicators that we have, and the demand improving and credit cycle picking up. Right. There is scope for this profit to GDP through the cycle to reach 5, 6, 7% over the next over the medium to long term. So the trajectory is very much there. But
so is it conceivable that the previous peak of 7.5%? Sure. So is it conceivable that the previous peak of 7.5 thereabout corporate profits to GDP could be taken out in the next 4 years?
Yeah, so that's difficult to say. So we can only predict whether a cycle is turning or not. How soon, how far, how much it will go, that time will only tell. But what can be said with certainty is the cycle has turned and it's on its way. And the high frequency indicators, if you look at Q1 results, we saw they were largely in line. Now, if I look at Q2 high frequency indicators till August, July, August, be it PMI, GST, credit growth, and the way inflation is panning out and how bond yields have been. So if you see last quarter, we also had treasury losses because bond yields spiked in India. And now this quarter, bond yields have actually cooled off for India, while it may have gone up for US. While crude and all the commodities you see have been are much lower than we saw in the previous quarter. So it's a nice environment to be where demand is holding up, if you see any demand parameter, while the input cost pressure, which was putting pressure on profitability, is reducing, right? So, so even from a near-term perspective, the profit cycle looks positive to me. And there are chances that there could be some, what I should say, upward revision also because of these factors.
Sure. Sure. Vinod, I'm curious to understand when our corporate profit levels were 7% odd in 2007-8, how are the valuations then? And now that we have troughed out at 4% and moving higher, 2% and moving higher, how does the valuation picture look? Just to understand how much of the profit revival is already captured in the price?
Yeah, so the best thing that is happening in this cycle where investment, profit, credit cycle all are picking up is that there is a check on valuation because we are simultaneously seeing the quantitative tightening in the developed markets. So that's keeping a lid on valuations. Otherwise, if you had a situation where we were still in a quantitative easing situation and you had such robust data and the flows, even the foreign flows would have started coming in that situation, you could have valuations run away basically beyond, it would reach very high levels. I mean, in October 21, we were at around 23x on a forward basis. Currently, we are at 19x. So we believe that this environment of quantitative tightening will continue to keep a lid on valuations, which I think is a very welcome environment to be when these cycles are still robust. So in 2007, if you see, valuations were in excess of, forward basis, in excess of 20x and all, 20 to 23x, I guess, if I remember right. But you have to remember that that multiple was provided on a very high profit base because the leverage effects were maximum at that point in time. This time, the leverage effects are still not there, sure, and the profit cycle is just turning. So to that extent, the valuation that has been ascribed is at a lesser risk currently, and it is not as high as we have seen in the past. So look at market cap to GDP, we are above. It's not as if we are cheap. We're still at 108, 107%, I think. But it's not at that 120, 130%, which is a kind of the upper range of valuation. So like valuations on P multiple, 22, 23 has been the maximum. And on price to book, we are at long-term average. So long-term average for the Nifty is around 3 times. We are at that level, basically. So valuations are definitely not extremely cheap or anything. They are at middle levels. But the point is the cycles are conducive. And this quantitative tightening cycle is not allowing runaway valuations, which is good from a market perspective because it avoids a bubble formation.
Vinod, one of your peers put out a note yesterday saying that there is visibility of 25% earnings growth next 4 or 5 years. Is that a sense you're getting? Is it this time the earnings cycle looks sustainable?
Yeah, so as I said, if you look at the consensus is building for a Nifty 50 around 16-17% growth. But if I look at the mid cap, small cap, the growth is, I think, much higher over there because they are coming from a low base. But as I said, I don't think the market is still building in effects of this operating and financial leverage, which will come in some time, maybe 2-3 years down the line. And that is where the profit cycle really picks up, as we have seen in the past cycles also. So the parameter for me will be how the ROE trajectory moves. So we are currently at 15%, and as it moves along, and moves to that 20% range, I think that is where the peak will start forming, and that's some time away. So the trajectory is definitely positive.
All right, Vinod, we'll let you go on that one. Always enjoy our conversations. Thanks very much for your time. That was Vinod Karki of ICICI, making a very valid point, which you need to take a note of. Okay, we'll move on and